somebody asked me the other day, like, what are your fees? Like, what do you charge? A lot of syndicators and fund managers, they have all these fees. And I wanted to go over, how does Bell Capital make money as a business, the business piece, not the real estate piece. So I want to go over our fees. If you go to bell-capital.com and you're an accredited investor, you register there, you will get access to everything. There's total transparency here. All the documents are there, the private placement, the operating agreement, the subscription agreement, the tax form. Um, you can read everything, all the disclosures, everything. And I'm going to go over today what our fees are, what we charge. So the way that most syndications and fund managers charge, all of them do the same thing. There's always a fee, but a lot of times it feels like it's hidden if you're not familiar with this business or the terms or anything like that. But we charge at Bell Capital what's called a 111 as it relates to our fees are concerned, what we charge as it relates to managing the money, managing the deals. This I'll get into. Again, it's all in the book as well. So if you, not the book, but in the private placement, if you go there, you register, you get to take a look at everything. That's the benefit of it. We're 100% transparent. You cannot raise money for a fund, a syndication, or anything without disclosures. There's 100% transparency in everything that any of these guys should be doing. So if you don't know, it's because of either lack of due diligence or somebody didn't explain it, which is what I want to do today. All right. So for us, we charge 1% for an acquisition fee, like basically to acquire a property. So if we go out and we buy a property for $80 million, we get 1% of that. That's built into the acquisition price, right? Still got to hit returns, but that fee is built in as a part of the cost, right? That's for us finding the deals, funding the deals, managing management companies that deal with it, the team, paying everybody, covering all of those costs of going off and finding and putting these deals together. It does cost money. That's number one. So that's the one fee that we charge. The second fee that we charge is an asset management fee. That is not a property management fee because we have a property management company that's going to charge anywhere from 3% to 4%, depending on the structure. But we charge to manage the management company, which is probably the more important thing in this. And I just want to share that with you guys. But we charge a 1% asset management fee that comes off of the income of the property. That's a 1% thing every month. So that's not a lot of money. We're not, so I know on Fund One, I did this because it's an introductory fund. It's our first fund, not my first deal, but our first fund with our investors. So the way that I did this was to only go off of the gross collection of the income of the property, 1%. But typically in a lot of these things, asset managers, some of the big guys like BlackRock, Blackstone, because they're asset managers, Starwood Capital, Equity Residential, they all charge an asset management fee off of the actual money that they raised, which could be huge. BlackRock raised a $600 billion fund. Starwood Capital, I think they raised a $300 million fund as of late. I can go back and look. But if you think about that, that's 1% of 300 million. That's $30 million a year that they take as an asset management fee just for being able to manage the assets because that's the amount of money they raised. We didn't do that on this fund. I will probably later. So if we raise another $50 million fund, we will get a 1% asset management fee, meaning that's the amount of money that we raised. All right, so that's what we charge on that. For now, it's the income of the asset. When we close a deal, we get 1% of that amount of collected rent per year to be able to cover our costs, operations, pay our employees, things like that, as well as to continue on going. And I'll give you an example of what that looks like. And then later, when we exit that deal, at the time of exit of the property, we take a 1% fee of that. All right. That's standard across the board. Some people take more than that, some people take less, but those are our fees. We do a 1-1-1 structure in our fund. I'm going to continue to do that. The only thing that may change is we may do an asset management fee off of the amount of money that we actually raise, which would be the fund amount. All right. Rather than the actual income of the property, because that just allows us to keep operations going. Because you want, a good team of people doing this, and it's based on the property and it's based on the performance. So, this one is the one, and this is here. Again, all of this is in the private placement memorandum. So if you go to bell-capital.com and you register there as an investor, you don't have to, it costs you nothing, but you get the opportunity to see my paperwork, how we're doing it, what to do it, do your due diligence, all the disclaimers, disclosures, all the risks that are associated with making an investment as an investor or as a limited partner in the fund. All of that stuff is there. But as a refinance fee, a lot of people don't talk about the refinance fees. There's a ton of fees. Like people can fee it all up. But the refinance fee. So let's say, for example, in most of my deals, my goal is not to sell the deal. My goal is to raise the income of the property, then go back to our lenders and refinance the property, refinance, put new financing on their new debt, and then take out the down payment that we did, right? So the money that we put down on a deal, take that money out and then give that back to our investors. So hopefully it's either a giant lump sum of all of our investment money back or the majority of it, 95, 99% of it back. But that is the equivalent of pulling money out. So when I do that, I'm going to go and sign on a new loan, give you all your money back, keep you in the deal, right? Because that's how I've done it in the past. You still get cash flow and you still get the same percentage of ownership in the deal, even though you have no more money in the deal. Now, in that refinance, I have signed on the debt. I'm now responsible for the debt. So I will take a 1% refinance fee on the actual the amount of money that I refinanced. So let's say we did an $80 million deal, we put 40% down, right? So $80 million, 40% down, we have a $32 million. And then later I go back and refinance that property. And I give all the investors, let's say it's 10 of us or 400 of us, 50 of us, whatever. Give all the investors their money back. They have no more. But now I have this new loan of, let's just say, $80 million because there's more equity in the deal. I'm going to take a 1% fee of the actual debt that I took on for my investors, and you guys didn't have to, right? So that way I can get something for compensation because that new loan of, let's say, $80 million is going to probably be another 5 to 7 year loan that I'm responsible for. I send on the debt, I'm responsible for it, not you guys. So for me to get another 800 grand out of that has to last over the next 5, 7, 10 years matters because that's how I'm going to continue to pay our people to manage the management company, make sure they're hitting their targets, make sure that my finance department is, paying the bills, paying the debt, sending over you guys' returns, keeping the accounting in place, making sure the taxes, all the attorneys that we would have to pay to cover any expenses, CPAs and accountants are lined up to go because all of this stuff takes money. So I wanted to share this part with you guys. So for all you people out there that are like, man, the fees, the fees, the fees, like, look, this is not a free business. I don't think it's bad as a business. The operational component of the business, like, look, if we find the deal, we charge 1% for that. It's not a lot. So I do have a comparison on this. Oh, I was going to kind of show you guys an example on that because we're working on $80 million deal somewhere in there, but let's just keep it simple. $80 million. So let's say we get a $80 million deal, 80 million. I'll just do that. Can you guys see that? Yep. So we did an $80 million deal. We get a 1% acquisition fee, 1%. That's 800K. That's what we get. Now, we're going to be in this deal anywhere from 7 to 10 years. I hope not, because if I can double, like everybody's looking for a double. We tell people, look, the goal is to double what we had in it, and the term is 7 to 10 years. Now, if I can do it in 5, I'm all in for that, right? But I'm just going over the fees. So, right, then we have a 1% management fee. Boom. So let's say that deal kicks out, I don't know, 200 units, 2,000 for, we may only get 400K, right? But again, that's a year. That's $40,000 a month or so, let's say $30,000 a month, but I have to pay my people. And each one of the people that are on my team, let's say I'm paying them $80,000 a year, right, for their salaries. And I have 10 people, that's 800,000. Where does that come from? This is not covering it. Right. So you get the discrepancy here where some people think, oh, you're crushing it on the fees. That's not always the case. And let's just say on a disposition fee, I'll write it all out. This fee, that's 1%. 1% of the sale. So let's say, because the goal on every deal, let's say we double the deal. And let's say when we sell this deal, we have to sell it for 120 million, because that'll be a double. 120, 20 million, right? That'll be another 1%, right? So that's 1.2 million that I would get out of that. That not me, the company, Bell Capital, right? Like this is the fee that we would charge to get rid of it. And the reason why that's important is because the last time we had a deal and I sold the deal with, I was the operating partner. I had investors, or I had one investor in that deal because we were partners, 50-50. This was a lesson for me. This was a while back. When I dealt that deal. I wasn't taking any fees. I didn't have a fund. I didn't syndicate the deal. This is just a straight JV. Um, I was still responsible in management changeover. So like maybe a month and a half, I was still almost 2 months. I was still dealing with that property, with the new management company, the changeover stuff. If they had questions, any issues that they had, the tenants are still connected to me. Like I had a text from one of the tenants, Miss Teresa, the other day, asking me was I okay, and she had seen the California stuff because you build a relationship with these people if you were what we were, which was managing the management team that I put together. But after something sells, there's still a responsibility for my team to stay in touch with the new transferring management company taking over the asset. So the disposition fee continue. I mean, it's still we still got to cover a cost. And again, this is for one property. So even if you were to take this and say, okay, fine, man, like you made this amount of money over time, 2.4 million, right? Yeah. And that's if I didn't, sorry, that's if I didn't um keep going on this. That's if I didn't, that's only one deal, right? And that's on a sale, right? Like I said, it would be no different. Now, if I did a refinance, then that refinance fee on a refinance would have been another, let's say, $80 million. Let's say I just refinanced up to cover our costs and we pulled out our equity 100%, and then I distributed that back to the investors. I made no money. Victor. Like I don't get anything until the 20% on the exit if I'm not an investor in the deal, which I will be. So I'll get a portion of that because I'm going to invest a portion of my acquisition fee, which is what I always do. I'm going to always invest back into the asset as an investor, not just sit on the other side of a general partner. I'm always going to be a limited partner too in my deals. So, but if I refinance and we pulled out I refinanced $80 million now, right? I cashed out the first loan and I brought it up to 80 million. I would get a 1% refinance fee, which is right here. It's called a refinance fee, paid at the time of refinance, 1% of the new loan amount, or other than negotiated, other than other or another amount that I would negotiate, which I probably wouldn't, right? 1%. So on that, I would get another 800 grand one time. But I'm still on the hook for the debt for however long that debt is, 5, 7, 10 years, whatever that is, right? So I just wanted to share with you guys how that would walk. But let's do this. So on that example right there, I think was at 2.4 million would be just my fees, but let's just say that happened over 10 years, right? That's only $240,000 a year that my company would have to operate on. So you figure like, why even do it? Right? Because that would be one deal. That's not on all the deals. That's there. So this actually would be all I would get because let's say I have an average because here's where we're headed. So I have an average of 12 employees and I'm going to pay everybody $80,000 a year. That would be $960,000, right? Just in employees alone for 12 employees at 80K. Right? So that's 960 right there. That's 960. That's $960,000, right? Just in salaries. Those are the CPAs, the accountants, executives, investor relations people, acquisitions team, people who are monitoring the management companies, the fund manager, asset managers, things like that. Like we're still going to need this. That's a six. Minus this, that's not a lot of money left over. That's not lease. That's not operations. That's not the systems that it takes to run. All of this has to be included in there. Remember, the investor portal costs money. The office, the leases cost money. All these things have to be paid for. So it's not just, oh, you got a deal and you're taking these fees. A lot of people don't get that. It's a business. I mean, it really is. So as a partner, I want to share that with you guys because, like I'm totally transparent about the fees. Again, that's the whole business of raising money. It costs money to raise money and it costs money to maintain these big assets over time to be able to manage your money well and to be able to do a good job. So this actually doesn't work, right? This doesn't work unless I get to scale. Because let's say, because my goal in this deal, let's say, and they're not all going to be $80 million deals, they're probably going to be closer to $100 million deals. This works if I do 10 of them. Let's say I do 10, right? Now we're at now we're at 200, we're at 20.4 million, right? Yeah. I had the 200 because I'm just going small right now in my conversation. This is not my goal. My goal is to get way bigger than that. But this works because this might not change. But again, this is just in fees. But I'm not doing it for the fees. I'm doing it because at some point we have a 20% split. We have an 80-20 split. This goes to the investors. This goes to us. Right. So I'm really doing it for the 20% split at the end of this thing, which means I need to do a good job for you guys. And I cannot do that if our company operations are broke. So the fees have to go along with this, but these are standard fees. Now, our fees are less than some other people's fees. And I was writing this down just to kind of give you an idea of the benefits, the ups and the downs on these fees. So I did Bell Capital, and this is Blackstone, and this is Fundrise. Fundrise is actually not. Fundrise is a platform. It's a crowdfunding platform. You go on there. They do have a structure like a REIT structure as well. There's a bunch of different stuff. But I wanted to kind of do a quick side by side adjustment so you can kind of see where we're at. So as it relates to for us, why it matters to me, we're talking about fees here, but this is kind of how this works up against other companies that have these fees, what the benefits of those are, what those benefits of other companies are, as well as ours, right? And I'm talking to you guys as if you were interested in investing with us. Like this is what I would share with people, some of the do's and the don'ts, the pluses and the minuses of where we are. So for an investor type, Bell Capital, we only deal with currently right now, we deal with accredited investors. Later, we will do some non-accredited investors. That's another thing. Fees are different on the non-accredited fund because the cost is different to start one at a time. But Bell Capital, we only do accredited investors only. Blackstone does accredited and non-accredited, but they're a REIT. It is very different. It's a different thing. So the structure of a REIT, that's different because you actually don't get the full benefits of being an owner like with us. If you invest with Bell Capital, you're investing in the real estate itself. You invest with Blackstone, you're investing in the REIT structure, right? So you don't get the tax benefits and all that other stuff. You invest in Fundrise, they have accredited and non-accredited investors because, like I said, they do have a REIT structure. And some of those deals that are on their crowdfunding platform, it's actually a platform where you get access to a bunch of different type of deals. All right, which gets me to the next one, the asset class. We focus specifically on multifamily real estate. That's it. We don't have a bunch of other stuff. And that's the challenge. Sometimes you're going to go to somebody else's crowdfunding platform and you're going to see a bunch of stuff. You're going to see a car wash, a multifamily deal, an office building, raw land. You're going to see a bunch of different opportunities. And that's the challenge, right? Because you don't have any like real true focus as it relates to some of these asset classes when we're talking about investing. Now we're looking at the benefits to, like first I showed you my fees, then I showed you who we are. I'm showing you a side by side chart on the benefits of doing it with somebody like me or someone else, right? Um, Blackstone, they do everything. They do everything. You're gonna see them doing and my guys out here doing the yard. But you're gonna see people who are actually out there, they're doing um like I said, the retail stuff, they're gonna be doing life sciences, they're gonna be doing the AI power centers, they're gonna be doing all that stuff, right? What is it called? Um Anyways, you know what I'm talking about. It's like a lot of warehouses and stuff like that. They're doing for the energy stuff for a lot of the AI, the needs that's happening. Same thing with them. They're gonna have everything there for as it relates to asset class. You can invest in anything, private credit, all that stuff, right? So direct to owner. Do you get to talk to the CEO or founder? Me? Yes, of course. My number's there. We do an investor Zoom call every Friday, 2 p.m. And you're welcome to go to bell-capital.com. You can schedule a call. You can actually text deal to 760-531-8500. And someone on my team will get back to you and answer any questions that you may have. And you can always have access to me here. Um, Blackstone, no, you are not going to get. I think it's John Gray. You're not going to get Steve Schwarzman. You're not going to get any of those people on the phone ever. As well as Fundrise. There's no one there running it. It's a platform. You might talk to a person here and there, but it's probably going to be a chat end or a chat bot. We don't use chat bots. So next, are there any middlemen? No, we don't have any middlemen, any brokers going source capital for us or nothing. If you talk to us, you're dealing with us straight. We don't have a middleman in between going to go raise capital for us. We just bypass the middleman, no brokers, no none of that stuff. So with them, absolutely. There's a middleman and our RIA, registered investment advisor. That's who they go to, financial advisors. They go to all these different people. Fundrise, you can go directly to Fundrise, but Fundrise, as it relates to the REIT structure, they because they have REITs. They do have a middleman. There is a fee for those things. So those are some of the additional fees that these guys may charge. Um, is your investment fully vested in the actual deal? With us, absolutely yes. So you invest 100 grand, 100 grand goes towards that deal. With Blackstone, no, because again, if there's a middleman and they raise money through a middleman, they're going to charge another 3% over the top of that for sourcing that money. So out of the money that's raised through a middleman, whether it's Fundrise or whether it's Blackstone or whether it's EQR or whether it's Starwood Capital, whatever, like the money, let's say you invest $1 million through an RIA because you're going to invest in one of their deals because that's who they source their capital from and institutions and things like that. 3% of that is going to go to the broker and the middleman who you talk to get you into the deal. So they're going to take their fee off the top. So if you're investing $1 million, you're losing 3% of that off the top. So your full $1 million is not actually going into that investment. So it's not actually fully invested in the deal. So that's no, and that's no. Is there an acquisition fee? Yes, there's an acquisition fee for us. Blackstone, they don't always have an acquisition fee, but they have a servicing fee. So they service that. So sometimes they're going to have one, sometimes they're not as it relates to acquisition fee. So it is not an acquisition fee, it's a servicing fee. Same thing with them. There's a setup fee. So you have to set certain things up and they do charge. Do they have a management fee? Yes, we have a 1% management fee. They have a quarter, 1.25% management fee. And sometimes they have less of a management fee depending on the REIT, right? Because they'll charge less. But we're talking about these guys will raise $300 billion at one time. So we're talking about a massive, like this is a $1 trillion company, like Blackstone is. Fundrise, also, they charge I think they do less than 0.25%. It's like 0.85. I think that's the last management fee that I saw. But again, they're a platform. So they charge a lot less. So if you're investing in somebody else's opportunity through them, I think there is a charge. You can go and do that research yourself, but it is there. Is there a split? We do an 80-20 split. 80% to the investors of the profit. Okay. 80% of the profit goes to the investors, 20% goes to us, right? So you're a limited partner, you get 80% of the upside of the deal. Blackstone, they do a 20% plus sometimes it's less depending on the size of the deal, depending on the exit, whether it's a REIT, whether it's an asset. But again, they're only dealing with like we said over here, investor type. This right, accredited, they do non-accredited, but it's inside of the REIT. And this is institutional only. I apologize. I said non-accredited, but it's really institutional. So they're going to take a portion of this. They're not going to work for nothing. If they're going to exit out of a big portfolio or a big deal, they're probably going to take 20% of the upside. This is really truly how it works. There's a limited partner and then there's the general partner. The limited partner are the investors, people like yourselves who are interested in getting passive income, passive upside, right? And somebody else does the work, which are the general partners. They put either a syndication or a fund together. And then when it sells, the profit that was made on the investment, they split that. It's usually a 80-20 split. Starwood Capital, which is not up there, Starwood Property Trust, which is run by Barry Sternlicht, they take a 20, they do an 80-20 split, sometimes less or sometimes more. But their fees are there. That's the difference. In this one, they do a 10-20 split at Fundrise on some of the REITs that they have or some of the assets that they go into. So that's how you can kind of tell the difference. But for us, we do an 80-20 split. They do a 20 plus. These guys do a 10 or 20. But again, some of these things you can't even, they're not great assets, right? I think they just had a challenge with some of their assets just recently. All right. So here's something else. Liquidity. With Bell Capital, it is an illiquid investment. You cannot just invest your money and then, oh, by the way, next I want to get my money back. Actually, more as an investor, you don't want to be liquid. You want to be illiquid. You don't want to be subject to being able to get access to your investments. You don't want to be subject to be able to, especially if it's in a real asset like us. We're going to real assets. We're not going to stocks. You don't want to have a challenge come up. You don't want to be able to trade out of it easily. You don't want to also be under attack for lawsuits and a bunch of other stuff because you're illiquid, right? Especially if you're investing as a limited partner in a fund or a syndication deal. Somebody can't just go after you, right? And make you sell if it's an illiquid asset, if it's an illiquid investment, and you can't just trade out of it. Blackstone, it's limited. Sometimes you can, it depends on where you are. Because again, they work with accredited investors. Really, when I say accredited, I'm talking about wealthy families, 50 or $100 million net worth or more, 200 million really. or they work with institutions, right? Like JP Morgan, Citi, Wells Fargo, like, or life insurance companies, or CalPERS, which is like the state employee pension fund for California. Um, the firemen's pension funds, the states, like it's very different. So they have a limited way to get out, right? And their typical way to trade, the one, they don't deal with regular people at all, they deal with institutions. So they're limited as it relates to liquidity. And at Fundrise, yes, there is some liquidity there, right? So you can get some of your money out if you're going to invest in a REIT, because now you're just trading shares, but you also don't get the benefit of the real estate, full benefit of the real estate. So investment transparency. Yes, you get to directly see the deals. Like I said, I can show you every deal that I like. I can show you every deal I don't like, every deal we've done, every deal we don't do. You get the opportunity to get full investment transparency. Um, Hell, you get the opportunity to review the documents, do your own due diligence, talk to me, find out what we're looking at. We do calls every week. We have an office. You can follow up with us. There's full-blown investment transparency all the time. So there's limited transparency here. If you're not an institution or a heavy hitter like a wealthy family or family office or something, you're not going to get the opportunity to see everything. They're a giant. They're a giant. They're the top of the top. So, and the same thing with Fundrise. It's a platform. You aren't always going to have investment transparency. You can't see why the person picking the deal, like myself, is picking that deal. They are not always going to tell you that, right? You're not going to get that from Fundrise for sure. And then the tax benefits, full tax benefits. Because if you're a limited partner, you're actually a partner in the real estate deal itself, right? Not just the company. So you're not investing in the company, you're investing in the real estate deal. You're a part of the asset, the fund, syndication that holds the deal. So you're an actual partner, you're an owner, right? And this one, it varies. Some of them it varies because depending on the structure that they're dealing with as it relates to the benefits for Blackstone, that's going to vary. But again, institutions, wealthy family offices, yes, when I say accredited, I'm not talking about the average person out there like we're talking about everyday small business owners, middle class millionaires, people like myself, you, regular people. We're talking about giants of industry, right? That are going for there. And also limited because it's a REIT. So you don't get all the tax benefits because it's a REIT. Because you're not really invested in the real estate itself. You get some tax benefits. You get some write-offs and things like that as being a shareholder in a REIT that owns the real estate, but you don't get full tax benefits of being an actual partner in the deal. All right. So I think that was it on those things. Yeah. And I was just going over a couple of other things, but I wanted to answer those questions for you guys and really go over it. So the big thing is like, hey, look, so why would you even do this? There's not a lot of money in the business side of this stuff, right? So number one reason why I'm doing this, and I want to share this with you guys. There's three reasons why I'm doing it. Realistic. Number one reason why I'm doing this is because I get to scale my business faster, right? There's no way to do enough deals. Like I've been doing deals for 20 years, but you're always going to run out of money if you're going to do the right deals. The deals that we're looking at are institutional quality, great deals. There's no way to save 35, 40, 80, $100 million, period. Like, so allowing more people to be able to do this with me, people like yourselves. I can scale my business faster. Lets me hit my goal. My goal is to get to $50 billion worth of real estate. It's not going to happen overnight. I know that's going to take time, but in order for me to do that, I got to scale my portfolio. That means partnering with great people who want to passively invest in great deals with me. And we go off there and do that. Which brings me to number two. The second reason why I'm doing this is because I know that I want to build a big audience of people that actually love me. The easiest way to build a big audience of people that love and care for you is to send them money every month that they don't have to work for. So if I sent you a check every month, or if I sent, your mom a check every month, or your dad a check every month, or your family a check every month that you didn't have to work for. You see the asset, you see me, we talk every month, you see the team, the things that we're working for, and you get a check every month, you will be rooting for me. You'll be like, dude, I love Vic, man. Keep at it, bro. Keep at it. I want you to win. Go close some more deals. Go do this. I got some more money to invest with you because I keep sending you money every month. I'm taking care of you and your family. Like my goal is to be able to send checks every month to you. And I can do that if I build a big network. Boom. Because I want to do that with you guys, right? Not the upper echelon, which leads me to number three. Because number three, I want everyday investors like you guys who deserve an opportunity at these deals, not just Blackstone, not just Fundrise, who has the world locked because they can go get institutional people and throw on their sites. Like the everyday investor the hardworking small business owner out there, the entrepreneur, the mom, the nurse, the doctor who has a practice, the person who runs a construction company. Like, we need those opportunities too for these institutional assets that are usually reserved for the wealthiest of the wealthy, wealthy companies, wealthy institutions. Like, at some point, we deserve it as well. So that's why I'm doing this. Those are my three things. One, I get to scale my business. Two, I get to build a big audience that I get to invest with so I can send money to you guys so you guys look out for me. And three, I get to help the everyday investor like myself get involved in these assets so we can all win together instead of going off to these big institutions and trying to raise money with them. They don't need any more investors and more money and control of these assets. I think we do. All right. So that's why I'm doing this. So those are our fees at Bell Capital. I wanted to share that with you guys for those who have asked that question. For the people who have asked me before, we do that 1-1-1 structure. I weighed up the pros and cons of going with us versus some of these other bigger groups out there. And naturally, you're not going to be able to go with them, all of them, maybe Fundrise. But I wanted to kind of show what the benefits of us against the benefits of them. All right. So I hope that helps. Let me know if you guys need anything. Like this video, share the video, comment on the video. Go to bell-capital.com. You can register there. You can take a look at all of these disclosures. You can go through all those fees, acquisition fees, management fees, refinance fees, disposition fees, any disclosures, disclaimers that we have in there about the risk, about associated with it. If you're interested in investing with us, reach out to us. Bell-capital.com, get started, register there. You can see that, or you can schedule a call with us or text 760-531-8500. That's 8500. 760-531-8500. Text the word deal, and one of us on the team will get out, we'll reach back out to you, answer any questions you have, give you all the information about getting invested with us, and we can go from there. So look, I appreciate you guys. Like the video, share the video, comment on the video, give it a thumbs up. Have a great day today. Let's go. Boom. Are you an accredited investor with $300,000 or more liquid in the bank? I want you to come and partner with me. Look, if you love real estate, passive income, and positive cash flow, appreciation over long periods of time, and you're willing to be patient, come invest with me. Go to bell-capital.com. This is for accredited investors with $300,000 or more in the bank, ready to go. Come invest with me. Go to bell-capital.com.